This is going to be a paper about shadow banking. Since shadow banking is a relatively recent and popular name now, it is attached to many concepts out there. So let me show you in a picture what I'm thinking about when I'm going to talk about shadow banking. So this is the traditional banking as we know it and we like it. There are investors who have money, borrowers who need money, investors give money to banks, banks give money to the borrowers, then these loans enter as assets of the bank, and then the bank issue debt that are liabilities to the investors, and typically banks have some capital, some skin on the game, and that's it. And typically these banks are regulated in many forms. One of the main regulations is capital requirement that says there is some minimum level of capital as a fraction of assets, typically risk-weighted assets. So assets that are riskier have a higher weight, count for more. And that's basically the bank as we know it. Now, when I'm thinking about shadow banking, I'm going to think about a particular part of securitization that was useful to get rid of these regulations. So it looked like this. So now the bank takes some of these assets, pool it, securitize it, tranche it, do it, all these things that they used to do. This will not be a paper about that. The whole point is that there is an SPV, a special purpose vehicle, typically sponsored by the bank, who is a master trust and hold the assets. They buy this asset from the bank. Where the money comes from, they basically issue short-term securitized bonds, asset-backed commercial paper, for example, to the investors. So the money flows through these guys here. Now, typically these securitized bonds are still guaranteed in one way or another by these assets that remain here. But these guarantees are constructed in a way such that the assets that are off balance sheet are not computed, are not used for the purposes of computing capital requirements. Okay? So basically that relaxes the capital requirements because capital over assets are higher. So this is one way in which the banks have been using particularly a lot recently to get rid or avoid capital requirements. So we know this paper is about the following. So we know that shadow banking is poor and then suddenly collapsed. And there is one leading narrative out there, which is the following. Since shadow banking was used to avoid regulation, and regulation is useful to discourage excessive risk-taking, then there was a lot of excessive risk-taking in the market. And at some point when this materializes, everything collapses. There are many open questions, if you think, in this story. One is why investors participated in this shadow banking in the first place. And then why they participated at very low rates, as if they were participating in traditional banking. So some people will tell you because they are non-sophisticated, they didn't know what was going on, maybe. But then you would expect a lot of excessive risk-taking happening before the crisis, and to be honest, there is no evidence about that at all. In fact, there is more and more evidence arriving that there was nothing wrong with the assets that were originated before the crisis. All right? We can talk about that later, but just to give you an idea that, for example, the central bank is making money with the assets that they bought with the TARP. So my take on this is different. My take on this is that shadow banking avoided regulation, but basically to take advantage, regulation is a discipline provided by the government. Now, when there is some discipline that is provided by the market through reputation concerns in this model, then investors are willing to participate if they trust that financial institutions will behave as if they are regulated, even when they're not. When that trust exists, they're willing to participate and also at a low rate. So this gives rise to an optimal self-regulation. When self-regulation exists in the market, it's optimally that banks regulate themselves. The problem is that when this trust evaporates, basically you have a movement from shadow banking back to traditional banking. But this collapse of the shadow banking is not because realization of excessive risk-taking in the past, but because of fear of excessive risk-taking in the future. All right? So now this has very important different implications for regulation, because rather than saying we should have to eliminate shadow banking at all, what we have to think is how to make shadow banking, or this system that is based on market discipline, more sustainable, more stable. Okay? So what I'm going to propose, or what I'm going to discuss here, there are many other potential policies that will work, is a combination of the standard regulation and some cross-subsidization across financial intermediaries in the market. All right? There is some literature that particularly now on shadow banking, some of you here, I will, for the interest of time, I will skip it, and we'll go directly to a Mickey Mouse type of model of reputation. I'm going to focus, reputation is inherently a dynamic concept, so we need a repeated game. But I'm going to focus in the forces that exist inside a single period, okay? So I'm going to be talking now, today on a single period. And there's going to be a continuum of investors in this economy, plain vanilla guys. They are risk neutral. Each one is endowed with $1, and they have an outside option at a free rate equal to 0. There's going to be a continuum of banks. These guys will be important for intermediating between the investors and some investment opportunities that I'm going to talk in the next slide. Each bank is also endowed with $1. And there's going to be two types of banks out there. Okay, some I'm going to call good banks and some I'm going to call bad banks. For simplicity, I'm going to assume that the good banks are the guys who care about the future, the bad banks don't care about the future. Now, this is a shortcut to say that good banks have some technological advantages and they're better in doing something when intermediating such that they're more likely to be alive in the future. That's why they care more about the future. So this is just a shortcut. Now, each bank knows its own type, but the agents don't. So the other agents in the economy will assign a probability a given bank is good, and I'm going to call that a reputation. Now, since in the background there's going to be a repeated game, but now I'm going to talk about one period, I'm going to say that if the bank survives, there's going to be some future continuation value that will be increasing in the reputation. Okay, so the higher the reputation, the higher is the value of continuing in the future. Think on this as the charter value of banks. And it's going to be also increasing in some fundamental. Okay, something like the business opportunities that are expected in the future. Some the economic activity that is expected in the future, the interest rates, whatever you want, some aggregate fundamental that moves the continuation values of banks. So what about the investment opportunities? It's going to be very simple. There's going to be two assets in this economy, one new asset. All of them will be stochastic. A new asset pays X with probability Px and 0 otherwise. This is going to be like a dummy asset, you're going to see. It's not that important. The interesting one is the old asset, because the old asset comes in two types. There are safe assets and risky assets. Think in boxes, okay? It can be a safe box and a risky box. The safe box pays YS with a probability PS and 0 otherwise. And in the risky box, inside the risky box, there can be two types of risky assets. A superior one with a probability alpha that pays with the same probability of success than the safe asset but pays more. So obviously this is superior. Or an inferior one with a probability 1 minus alpha who pays more in case of success, but with a lower probability. Okay? So now, basically what I'm going to assume is, first of all, only banks can invest in these assets. And second, that only banks can open the lid of the risky asset box. Okay? Banks exist, or one of the advantages of banks is that they can know what is inside the risky asset box. Okay? They can know whether it's a superior asset or an inferior asset. Now, each asset will cost $1, and the assumptions on the payoffs will be the following. In expectation, the new asset pays more than any old asset. The superior asset, of course, pays more than the safe asset, and the safe asset pays, in expectation, more than the inferior risky asset. Okay? But all of them has a positive NPV. Finally, since there are $2 in the economy, there's going to be only investment in two assets, and the bank can borrow the dollar from the investors and the endogenous rate R. So this is the economy. So this is going to be the timing. Very simple. Again, it's a simple period, right? So at the beginning of the period, the distribution of these thetas will be known by everybody. Okay? Theta is still not realized. Everybody understands that this fundamental, aggregate fundamental, that index the expected gains from the future, will come from a normal distribution with a mean mu and certain variance. And now a bank that has a given type and a given reputation will choose whether to finance itself, to use traditional banking to raise that dollar, or to use shadow banking to raise that dollar. And there's going to be interest rates in the traditional banking or in the shadow banking that will be determined endogenously. Then, after the financing happens, agents observe the theta, everybody observes the theta, the banks observe the type of the risky asset, so the bank opened the risky asset lid. And now, and I'm going to explain why, but let me just assert it here. If the bank issue debt, it is forced, because it's going to be in traditional banking and it's going to be regulated, it is forced to invest in the safe asset. And I'm going to explain in a second why. if the bank issues security, it's gonna be able or free to choose the investment, to invest in the safe or the risky asset. Then at the end of the period, the assets pay. If an asset pays, the bank continues with a new reputation potentially and enjoys a continuation value. And as a normalization, if no asset pays, the bank disappears and gets zero. And investors only observe repayment or default. That's the only thing that the investors will observe here. All right? So let me put this model in the picture. So this is a picture that I showed you before, the traditional banking. Investors, but in our example, investors give $1 to the bank has $1, it put the money with the borrowers. Let's say that the bank invests optimally. Investing optimally means that it always invests in the new asset, and it invests with a probability alpha. The risky asset is superior, and invests in the superior risky asset. With a probability 1 minus alpha, the risky asset is inferior and invests in the safe asset. Okay? This is the thing that maximizes the size of the pie. Since the probability of success of the old asset is always PS, how much investors will charge in this situation? Well, they're going to break even. The interest rate that they're going to charge is how much money they put, $1, divided the probability of getting their money back. It's going to be, if the new asset succeeds, it gets the money. If the new asset fails, it gets the money if the old asset succeeds. Fine? So far, so good. Nothing new here. And this is going to account for some expected profits for the bank that account for limited liability. So the expected profit is the usual thing. This is just an algebraic way to write all the potential nodes. Basically, if the new asset pays, it gets the money minus the interest rate. If the old asset pays, it gets money minus the interest rate that they have to pay if there is no payment from the new asset. So, but now to introduce something interesting going on here, I'm going to ask, what if the bank decides to invest always in the risky asset? Okay? Investing always in the risky asset implies that the size of the pie goes down by the assumptions. The inferior risky asset is worse than the safe asset. However, the expected profit that the bank makes can be higher than before. Why is that? Because even when the size of the pie gets down, it pays the interest rate with a lower probability. This is the standard risk shifting problem, the moral hazard problem. But now this introduces a problem, because if investors understand that these are the incentives of the bank, now they're going to charge a higher interest rate because the probability of repayment is lower. So they're going to charge some higher interest rate. But now if they charge a higher interest rate in this equilibrium, the expected profits of the bank will be lower. So what this tells you is that a bank would love to commit to invest optimally, but it cannot. So at the end of the day, if there is nothing else going on here, the banks, you have a situation with high interest rates and low total output. Because the bank would love to commit to do the optimal thing, but it cannot. All right? So this is a problem. Now we can start asking what a regulator could do. Let's say that now you have a regulator potentially who cannot observe what is inside the risky box, but can observe whether the bank invests in the safe asset or the risky asset. Let's say treasury bills versus subprime mortgage. But among the subprime mortgages, the regulator doesn't know which are the good mortgages or the bad mortgages. All right? Well, then potentially a regulator can say, look, you have to invest always in the safe asset. That's better because of our assumptions. So you always invest in the safe asset. The problem is that now there is something lost. There are some superior risky assets that get lost in the process. But if this gives an expected profit which is higher than what would get in equilibrium, then the bank, the regulator, is basically providing to the bank a commitment device which is not perfect, because the commitment device that is perfect would be this one that gives more profit than that one, but still is better than no commitment at all. Okay? So this is the way you're going to think about regulators here. A regulator provides an imperfect commitment device to the banks in order to avoid excessive risk-taking all the time. Now, one way you can think about providing this commitment device is through capital requirements. How this works here? Well, a regulator can say, look, I'm going to create a capital requirement. It's your capital divided your weighted assets, where these are the weight for the new asset and the weight for the safe asset, should be greater or equal than certain capital requirement. Now, if the regulator sets these weights and the capital requirement good enough, or relatively well, then it guarantees themselves that the bank has to invest in the safe asset always. All right? So this is why I'm saying, or when I describe the timing, I'm going to assume that this is what happens. So this is what I'm going to assume. This is a problem that I'm going to assume, basically, that capital requirements are there to provide a commitment device that is inferior than the one that market would provide, but it's better than nothing. Now, obviously, so far, I haven't been talking about the future. Now let's introduce the future here, okay? Let's say that now the future starts mattering. You have some value that could come in the future. Now these expected profits become expected discounted profit, and there is some value that comes in the future that will start looking like that. As you increase the value from the future, obviously, you're increasing relatively faster the gains if you invest in the optimal asset or in the safe asset, because the probability of success, the probability of being alive in the market is higher in these two situations. Remember, PS. If you invest in the risky asset, it's more likely that you disappear, and then you cannot get advantage of the values of the future. So at some point, if the value of the future becomes relatively good, you don't have the commitment problem anymore. In your own interest, you prefer to invest in the optimally. And on top of that, it's better than going through regulation. So if this is the situation, once the future becomes good enough, the banks don't want to select into the inferior commitment technology that traditional banking gives. They prefer just to go around and commit to them by themselves. How they do this in this very simple model? Well, they're going to securitize some part that they need to invest from the investors. In this situation, there will not be investor coming directly here. So they're going to gather this money. They're going to take a fraction of the new assets. They're going to put it off balance sheet. And what this does basically is that obviously now that reduces the denominator in the capital requirement. Now you have all these guys off balance sheet. So the capital requirement relaxes in this situation. But on top of that, it can also relax. It can be relaxed even if they invest in the risky asset. If these guys put a capital requirement equal to 1, then shadow banking cannot be used at all. Even when it's optimally for capital, even when it would be optimally for this guy to be able to get around it. Okay? Why is that? Because this situation couldn't be fulfilled. Okay? So this is how I think about the use of shadow banking. It enters when there is this possibility of disciplining themselves. Now, what is important is that this interest rate that the investors will charge in shadow banking now will depend on many things. In particular, it will depend on the expected value of the future. And that expected value of the future will depend on the reputation of the banks and will depend on how good we think that the economy will behave in the future. Okay? So let me show you now where this comes from and how this is endogenously determined. So shadow banking, okay, the equilibrium in shadow banking will affect two things: the reputation updating by the banks and the interest rate that the banks have to pay in shadow banking. So this is how the equilibrium will look like, effectively. I'm going to assert it, and then I'm going to tell you where this comes from. There's going to be a threshold on fundamentals such that a bank with reputation fee, when the fundamentals are above that threshold, the good banks will decide to invest optimally, self-discipline, basically. Below that fundamental, they're going to decide to take excessive risk. So the bad banks, these are the probability of repayment by the bad banks, they don't care about the future. So it's the same picture that I showed you at the beginning. So the probability of repayment by them is always the same. But for the good banks, the probability of repayment when the fundamentals are low are the same that for the bad banks. And the probability of repayment by the good banks when the fundamentals are high are higher than for the bad banks. And the reason is that in this situation, the good banks invest optimally, invest in the safe asset when the risky asset is inferior. What this immediately tells you is that if an investor observes this theta and observes that a bank repaid, will assign a higher probability that that bank is good. This is the Bayesian updating. Why is that? Because he knows that the good bank would be able to invest optimally in that situation. They care about the future. If an investor observes this fundamental and observes repayment, it doesn't assign anything new. Good and bad banks behave the same, so the reputation doesn't get updated at all. So number one, when this theta star, this cutoff that will arise in equilibrium is low, that implies that there are some high expected gains from reputation, some high expected reputation gains for the bank. Number two, this affects the interest rates. Since interest rates are determined before the fundamentals are realized, they're determined in expectation. If this is the threshold, this is in expectation, this is the probability that the good banks will take excessive risk, and this is going to be given the probability that the good banks will invest optimally. All right? So now the investors will compute the expected probability that a good bank will repay, and this is going to be basically a convex combination given by these masses between investing optimally in this part of the normal distribution, in this case normal distribution, it doesn't matter, or taking excessive risk. All right? So point number 2, when there are a low theta, there's going to be in general low interest rates. But what is important is that in shadow banking, remember, in traditional banking, the interest rate don't depend on anything. It doesn't depend on reputation, it doesn't depend on theta, it doesn't depend on anything. Why is that? Because the bank always invests in the safe asset. Okay? So the probability of repayment is the same. It doesn't matter on anything else. The interest rate in shadow banking will depend on 2 things. Will depend on the reputation of the bank, because this is in the denominator is the expected probability of repayment. If the bank is bad, with this probability, they repay with low probability. If the bank is good, it's going to repay with some other probability, and this other probability will depend on the expected beliefs about this distribution, where this distribution is located. All right? So there can be situations, effectively, that when mu is very high, it's very likely that the good banks behave as if they were regulated, okay? And then the interest rate will be lower. Now, these are the 2 main takes here. The question is how theta star is determined. Here, there is a multiplicity that comes here that is given by reputation, and you can see it immediately here because there is a discontinuous change in the update of reputation that I solve using global games. It doesn't really matter. The important part is that you can solve this threshold in equilibrium, a unique one if you select using global games. And now, the question is how this threshold will depend on phi and will depend on mu. How it depends on phi is easy. When the reputation of the bank is higher, they care more about the future, so this thing will move to your left. How does this depend on mu? Well, let's assume that the distribution, some bad news, the distribution moved to your left. Now, given the same threshold, it's more likely that the same bank will take more risk. There's going to be fundamentals more likely that he's going to take excessive risk. That will immediately increase interest rates that will be charged in shadow banking. Because there are more interest rates in shadow banking, these banks endogenously want to take more risk. So that will move the threshold up. So there is some kind of feedback effect between this bad news and the interest rate in shadow banking that will look like fragility, depending on the shapes of these variables. Now, the question at the beginning was, what is, when these guys will select into traditional shadow banking? Let me just give you the intuition here. When the mu is high, good banks will very likely invest optimally. That implies low rates and high expected reputation in shadow banking, and then it's more tempting to issue securities and participate in the shadow banking. Let me show you in a picture. Let's imagine a bank that has a reputation 0.5 and is good. These are the probabilities of taking excessive risk. When mu is high, it's very likely that those banks take excessive risk. When mu is high, it's very unlikely. It's very likely that they're going to play optimally. Now, that gets translated into the interest rate that they're going to be charged in the shadow banking. And now you can compute what are the expected discounted profits for different mu's of participating in the traditional banking, which is the blue line, or the shadow banking, which is the red line. So when mu is relatively high, these guys will decide to go to shadow banking. This is for a reputation 0.5, but we can do the same for all reputation levels. So here you have the mu, the expected economic conditions, and here you have the reputation levels from 0 to 1. So when mu is high, you're going to have a bunch of banks participating in shadow banking. What is interesting is that these are banks that have relatively good reputation, which is consistent with the data. Particularly big banks or banks that are considered relatively good are the ones who were participating mostly in this system or in this type of banking. Now, when mu collapses, or when mu started to collapse, at some point, the interest rates started to shack up in the shadow banking, something that we also observed in the recent crisis. And now banks endogenously decide to go back and buy, if you want, or select into the commitment technology that traditional banking proposes. And then they go to traditional banking. But that represents lower output, because there are some good investment opportunities that will be lost from participating in traditional banking. Now, basically what this tells you is that In this particular model, shadow banking doesn't have anything bad. All the contrary. Is a possibility that the market gives you to invest optimally, to exploit the gains that or the particular advantages of banks. Okay? So tightening capital requirements here not only will reduce output, but potentially will exacerbate volatility. Because now it depends on how this plays. Some banks may decide to jump to shadow banking even when they're not that great banks. Okay? So what I'm going to do here is to propose a combination, there may be many other policies, of capital requirements and self-finance cross-subsidization that make shadow banking more sustainable. So let me tell you just a little bit the intuition, because I have only 3 minutes. Imagine that you set transfers that are increasing in fee, for a second, increasing in reputation, such that that affects the continuation value. If you want to make this budget balance, that implies that you're going to have to subsidize some banks and tax some other banks. Okay? So there's going to be some fee bar above which you're going to subsidize, below which you're going to tax. Now, what you're doing is, for all those banks that you end up taxing, the ones with low reputation, if they were participating in shadow banking, they would have less incentives to behave. When you subsidize the banks with high reputation, if they were participating in shadow banking, they would have more incentives to behave. But this is a good policy because you don't care that much on reducing the incentives for the bad banks or with low reputation to participate in shadow banking, because in any case they select into traditional banking. So effectively what you're doing is you're maintaining the incentive for the good banks to participate in shadow banking, and on top of that you make their participation in shadow banking and their incentives to behave less sensitive to changes in the fundamentals. So let me just show you a picture. This blue line is a selection into shadow banking that I was showing you in the simple model. And here I'm going to just put a regulation of these transfers. It's just an exercise. There is no intentions of quantitative anything here that will create this flatter participation in shadow banking. So imagine that you're in a situation with this mu most of the time. So with the regulation, with this cross-subsidization, you don't affect how many banks participate in shadow banking. If you have a collapse in mu, however, it would imply, without the cross-subsidization, a big movement to traditional banking that doesn't happen if you cross-subsidize. Okay? Now, just to wrap up, something here, I just give some simulations where you have expected total production. With the regulation that I'm proposing, you can have, in average, more production and also lower volatility. But just to wrap up, something that I want to mention is that if you think that reputation is correlated with size, then it's not politically correct to say, look, tax the small guys and subsidize the big banks. All right? So something that it would be interesting to think is how bailouts effectively introduce a hidden subsidy to big banks. Okay? Because the typical story of bailouts and too big to fail are the following. Big banks, you give them this implicit guarantee, and then they have incentives to misbehave. But that's assuming that the big bank born big bank. It's not assuming, but typically the way at least I think it works, is that big banks become big banks. So if you give them some extra subsidies, you're increasing their incentives for them to become big banks and to maintain or to remain being big banks in the first place. All right? So let me stop there.
All right. So thanks a lot for inviting me to discuss this paper. It was a very nice paper, and I learned a lot. So the general idea of the paper, as Guillermo explained, is to think about the shadow banking as beneficial to the economy. Okay, so this is a little bit provoking because people typically think that shadow banking is something bad that we want to sort of avoid, especially in light of the recent recession. Instead, the model shows that actually there can be reasons why the shadow banking may be beneficial, and in particular, this is the case when reputational concerns are important in the economy, and banks cares about this reputation. So the way in which we are going to think about shadow banking is that banks have a choice if being a traditional bank or or work in a shadow banking system. And the idea is that if banks have some superior information, they actually participate into using the shadow banking system may be good because a traditional banking system typically imposes a regulation. and so impose some restriction on the risk that banks can take. But if the banks have some good information, superior information relatively to the regulator about the opportunity of that this risk taking is going to give to them, it may actually be beneficial, okay? Because they may actually take the good risk. So if reputational concerns are strong enough in this model, the shadow banking system is going to increase output. Now, the fragility, given that this is a conference on fragility, the fragility kick into the model is that these reputational concerns may become suddenly very small if there is a fundamental shock to the economy or a bad news or something that hit the economy and makes reputation be less valuable. In that case, we may shift from a situation where lots of banks are going to participate into the shadow bank system into a situation where we go back to the traditional banking system, and this is going to be sort of the fragility in the model. So I'm going to present a very simplified version of the model. I mean, not very, but a little bit. So there are two periods, and there is a continuum of banks and a continuum of lenders. So there are two types of banks, as in Guillermo talk, good banks and bad banks. Good banks care about the future, so they have a beta that is positive. Bad banks don't care about the future, so their beta is 0. This means that good banks can care potentially about reputation. Bad banks don't care about reputation at all. Phi is going to be the reputation of a bank to be good, so the probability that a bank is good. And V of phi is going to be this exogenous continuation value that a bank is going to get in the second period if as reputation phi. And V is going to be increasing in phi, so the higher the reputation, the higher the continuation value. This can stand for many things that are outside the model, and this is a nice, simple way of capturing this. So when we want to think about the fragility part, this V is going to depend on the aggregate shock as well. And so if there is a bad shock, then for a given phi, the value of reputation is going to be lower. So this is the way in which the model is captured. There are two assets. So forget about the new assets. There is only one safe asset that pays YS with probability PS, and there is a risky asset. The risky asset with probability alpha is going to be superior, and with probability 1 minus alpha is going to end up being inferior to the safe assets, in the sense that when it's superior, it pays YR that is bigger than YS with the same probability. And when it's inferior, it pays still something that is higher than YS, YR, but with a lower probability. And YR times PR is going to be smaller than YS times PS. So a bank needs 1 unit of capital to invest in either assets, but the bank is born with no capital, so it has to borrow to invest, to finance itself. And there is a continuum of lenders that are short-lived, risk-neutral, and competitive, who can lend to the bank. So there are some assumptions here, assumptions on payoffs and probabilities that are important for the results. First of all, the safe assets have a higher expected payoff than the risky assets. So if there is no information about if the risky asset is superior or inferior, it's better to invest in the safe asset. If instead we have the information if the risky asset ends up being superior or inferior, then it's better to invest in the risky asset if it's superior and in the safe assets if it's inferior. Expected payoff in the good, whenever the asset pays back the money that the payoff is going to be sufficient to repay the interest on the financing. Okay, so whenever there is success, the bank is going to repay. And then this is an important assumption, there is risk shifting into the model. So once take into consideration the fact that the bank is going to commit ex ante to a fixed repayment R, then it's going to always be better for the bank to invest in the risky asset. There is this choice that the banks face. The first choice that the bank faces is to participate to a traditional banking system or to participate to a shadow banking system. If the bank decides to be a traditional bank, then it can only invest in safe assets, and the interest rate that she's going to be charged to borrow is going to be just 1/PS, because the lenders have to be compensated for the fact that they're going to be repaid only with some probability. Okay, so this R is bigger than 1. If the bank decides to participate to the shadow banking system, well, then she can choose the portfolio allocation that she prefers. She can choose whatever investment she wants, the risky asset or the safe assets. And the tau is going to denote the strategy of the good bank, meaning the good bank is going to choose tau. When the good bank chooses tau equal 1, it means that the good bank decides to invest in the risky asset only if it's superior, and in the safe assets if the risky asset is inferior, while tau equal 0 means that the good bank is always going to choose the risky assets. Okay? So it's going to behave as the bad banks. So PGT, tau, and PB are the probability that a good bank, respectively a good bank, repays, given that tau is the strategy that is going to follow in equilibrium, and PB is the probability that the bad bank repays. Okay? So the good bank is going to repay, when the asset is superior with probability alpha, it's going to repay with probability PS, because invested in the risky assets that repays with probability PS. With probability 1 minus alpha, when the asset is risky, well, if she's behaving optimally, as in the Guillermo words, then also it's going to repay with probability PS, because she's going to choose to switch to the safe assets, because the risky assets is inferior. If instead she take the risk, then she's going to actually repay only with probability PR, because it stays with the risky asset, but now the risky assets repays with lower probability. And while the bad banks is always going to stay with the risky asset. So then now the interest rate at which the banks can borrow if she's participating into the shadow banking system is going to be an interest rate that is bigger than the one that arises in the traditional banking system, because now the lenders are going to take into consideration that the banks are going to they're going to be good banks and bad banks, and even in an equilibrium where tau is 1, so the good banks behave well, there are going to be always bad banks who takes too much risk. So they want to be compensated for that, and the interest rate is going to be higher than R. Now, the timing, just to sum up, the timing, at the beginning of the period, each bank makes its financing choice, either traditional banking or shadow banking. If she decides to go with the shadow banking, can make a portfolio decision, investment decision, otherwise she has to go with a safe asset. If the bank does not repay, then she gets a continuation value 0. And if it repays, the market beliefs are going to potentially be updated to phi prime, and V of phi prime is the continuation value. So there is okay, let's now assume that the bank chooses the shadow banking system, and then we'll go backward to the financing choice. Okay? If the bank chooses the shadow banking system, then there are two possible equilibria. One with reputation and one with no reputation. So with reputation, in the reputational equilibrium, what happens is that the good bank chooses to invest in the safe asset if the risky asset is inferior. So this means that the lenders know that the good banks has a higher probability of success, because the bad banks takes more risk, so has higher probability of fail. So this means that if the lender observes success, they're going to update upward the belief that the bank is a good bank. But then this increases the continuation value for the good banks, and so give the advantage for the good bank that compensate for the cost of not taking the risky investment ex ante and sustain this equilibrium. In the other equilibrium, instead, the optimal strategy for the good bank is always take the risky investment, the risky asset. So this means that the lenders know that good and bad banks behave in the same way, so they have the same success probability. So if there is a success, there is no update in the belief about the quality of the bank. And so this doesn't give any advantage, any reputational advantage to the bank, and so there is going to be no reason to pay a cost, and the good bank is going to go with the risky asset as well. Now let's go backward. Now we have the financing choice to make, knowing what's going to be what's going to happen in the shadow banking. So this is the value of a good bank if it chooses to behave as a traditional bank. So it's going to get the PS is going to be the probability of success. This is the payoff if she succeeds. And this is the cost of repayment and financing, plus she's going to get the continuation value from the belief that is not going to be updated. It's just going to be constant, but still is there. If instead she participates to the shadow banking system, the good bank, then her payoff, oh, there is a fee missing here. This depends on fee as well. So if she participates to the shadow banking system, then what's going to get? Well, this is the expected payoff of the bank that depends on the strategy that she chooses and on the realization of the risky asset being superior or inferior. She's going to pay this interest rate with the probability of success being PG of tau. And she's going to get a continuation value that now depends on the new belief, on the posterior belief that is updated potentially if tau is 1. Or is constant if tau is 0. So, I mean, you can see that you can think a little bit about that and think, what happens if phi is higher? If as phi is higher, as the reputation is higher, what's going to happen is that what the banks has to repay in the shadow banking system is less, right? Because now the lenders think that there is a higher probability that the bank is good. And the continuation value that the bank is going to get is weakly higher, meaning it's strictly higher if tau is 1 is the same as tau is 0. So for both these reasons, the utility in participating to a shadow banking system is going to increase, which means that actually there is going to be a fee high enough such that for fee high enough, the bank is going to choose the shadow banking system. What about the bad bank? Well, the bad bank will behave as the good bank, because if the good bank chooses the shadow system, well, for the interest rate is going to be relatively low because she's going to be cross-subsidized by the good bank, and so she can choose the shadow system as well and take the risky, invest in the risky asset. That is what she want to do. If instead the good bank chooses the traditional system, well, then the interest rate would be very high because lenders know that if you look at the shadow system, there is going to be only bad banks, and so it's not going to be profitable, and the bad bank is going to choose the traditional system as well. Now, there is one thing that I think is not in the paper, that there is here another source of multiplicity that comes from the fact that actually, well, when phi is low enough, then no, there is one equilibrium, and the banks, both good and bad banks, participate into the traditional banking system. But when phi is high enough, the good banks and the good banks would find the shadow banking system optimal. Actually, it depends, in truth, it depends on the beliefs of the lenders. So there may be two equilibrium, one with the traditional banking and one with the shadow banking system, because an equilibrium with traditional banking may be sustained by the fact that people believe that the good banks are choosing the traditional banking system. In that case, even if a good bank tries to go into the shadow banking system because it thinks it would be optimal for them to take the risk, well, but then the lenders think that it's a bad bank, and so it's going to charge a very high interest rate and is not going to update the belief. So there is no advantage really to go there. So it's going to stay with this traditional banking system. So there is a need for refinement there. I mean, I think it's very easy to find a refinement that kills this equilibrium, but that's something that is. Last point that I'm going to make is about efficiency. So Guillermo talked a lot about regulation. I think it's nice, but in truth, he's talking about a trade-off between volatility and output that is not really into the paper, meaning volatility doesn't play any role in the utility of these guys because they are risk neutral. So I think another interesting direction to go to think about regulation is to think about the efficiency of the choice of, I mean, is the shadow banking system too small or too big in the eyes of the model, right? So let's think about the social surplus with traditional banking that we would obtain in if the traditional banking system is used, and this is the social surplus with shadow banking. Okay? If the traditional banking is used, well, PSYS is the payoff. The cost for the social cost is 1, because the cost of borrowing 1 is 1. And this is the value of reputation for fee for the good bank. In the shadow banking system, this is going to be the payoff, okay, plus this, sorry, this is all going to be the payoff. And then the cost is still 1, and this is going to be the continuation value coming from the reputation. We have already seen what is the value for the good bank. Now, in the model, the choice between, we said that the choice between shadow and traditional banking system is really made by the good bank. Let's assume that we select the equilibrium where if the shadow banking system is in equilibrium, this is going to be the equilibrium we pick. Then what's going to happen? So, okay, then we can find the fee, the marginal fee, such that the good bank is going to choose is going to switch from the banking to the shadow system, and ask the question: is this what is maximizing the social surpluses or not? And in particular, this is what we get if we do this exercise and we plug in the marginal fee for the good bank into the social surplus difference equation. And we get that actually the shadow banking system potentially can be too big or too small. In particular, it can be too small if the sum of these 3 terms is positive. What are these 3 terms? First of all, it may be too small because the price of financing, the cost of financing for the good firm is higher than 1, and it's high because they are cross-subsidizing the bad banks who are participating in the shadow banking system as well. Second, though, so these tend to go towards the fact that the shadow banking may be too small because they may not invest enough because the cost of financing is so high. On the other hand, they're actually having a negative externality on the economy, which is that if the good bank chooses to participate in the shadow banking system, well, the bad bank is going to do that too, and so the bad bank is going to take excessive risk. So this term is there and goes in the opposite direction. And then there is another term that tells me that actually they do not, the good bank doesn't internalize the fact that the reputational advantage is not relevant for the bad banks that are still participating in the economy. Okay? So if we are in a no reputation equilibrium, so tau is 0, well, then you can see that all these terms disappears. This is 0 equal to 0, and actually the financing choice is going to be efficient. If instead we are in a reputation equilibrium, it seems that the sign is ambiguous. Now, I haven't done numerical examples, but it seems it could go both ways. That's it. So it was a very nice paper, and I liked a lot the idea that the shadow banking system may be beneficial. I think it's interesting to go a little bit more in the efficiency analysis to push the regulation in that direction. And thank you.
So I guess in practice, that I think about the shadow banking probably is that actually the banks, traditional banks, are doing both. And we thought it was that's really the problem, that when the shadow banks kind of opaque it and gets into really bad, then the traditional bank has to take off. So it seems like your model 0, 1, and also the recognition updating doesn't apply to this. Like actually they are doing both, and I don't know how to update on these two. So it would be nice to have some of the discussion.
One lesson here is that the bank does want to today will keep the continuation value high tomorrow, right? So I think of continuation value is very for your salaries and forward. So this is a provocative conclusion from the paper that all these efforts to raise the compensation to bankers has that actually made banking prices worse. And that sounds like a conclusion of the report. Are there more questions?
I wonder, this machinery would seem to apply just to an investment fund that wasn't a bank at all, that issued bonds or debt. And it doesn't seem like an expectation of bailouts or deposit insurance plays any role here. And yet, a lot of what happened in the financial crisis did seem to be trading on, well, an effort of institutions to conceal their real type, making use of, well, regulation.
Didn't see too much role for sort of capital in the shadow bank that much. I mean, it seems like the idea, the better the reputation you have, the less actual capital you have to retain for incentives. If you have this extra collateral, you lose your reputation. That's a loss. I was wondering if the bank, if there wasn't some possibility for separation of the bank, of the good banks who were pooled together but had a good enough reputation through shadow banking, to retain a bigger piece of the stuff that they put into shadow bank to try to deter the bad types from wanting to do that. And it was also unclear to me what this loss of value was. Could you potentially lose your banking franchise at the same time you defaulted on your shadow bank? If that's the way you're doing it? Because you couldn't, because you don't have to do that. I mean, presumably things like Citi put these things back on balance sheet because they wanted to keep their reputation rather than that they had.
So one more question.
Well, I guess it was a related point to say how you think about the reputation. One of the things, what prevents the regulator from just grabbing a traditional bank and somehow weaving reputational element into normal banking by giving him some information? You know, one of the issues that was discussed at some point was that maybe there was too much competition in banking, and that's what prevented people from having a positive confirmation that if you create franchises that are worth more and so on, then you could embed the reputation. Just normal banking is this related?
Okay, so let me start thanking Veronica. It was a great discussion. To be honest, I haven't thought about this question about whether the shadow banking is too small or too large. I think it's an interesting question to ask. And as you're showing, it can go both ways. So I was, I think, focusing more on the possibility that there is a regulation or a policy intervention that gives you both a higher output and a lower volatility. So even if you have risk aversion, etc., this is going to be a win-win situation. But what you're pushing here is even without any other policy, whether with the policies that we have right now, whether shadow banking can be too large or too big. I think that's an interesting question to follow.
Yeah, I think the important thing of your model is that it can be too small.
No, right. No, exactly. In terms of the model, it can be very too small. And that's why I think it's quantitatively interesting. Now, with respect to, let me answer Alberto and Doug's question. The way I think about reputation is true in the model just as a normalization. When you default, you lose all of it. You can think that even if that's not the case, as soon as you have a reduction, that's going to be important to maintain. Let's call this V charter value, for example. Then as long as you reduce your charter value, as long as you go through a bankruptcy procedure, etc., everything would work the same. And there was these questions as well that in general, if you introduce more competition, the charter values goes down, and that generate less incentives for bankers to behave. And there was a big discussion whether that reduces discipline inside the banking system. Okay, so in fact, one of the more stable financial systems are Canada, very few banks and high charter values. So in fact, that would be an extreme case of this, in which the charter values are so high that the picture that I show you is pretty flat. It doesn't really, is not very sensitive to changes in expectations about the future because they're really high anyways. So when it's high anyways, any change in the future doesn't really affect the charter values. That will not affect, even when you participate in shadow banking, there is
A little tension is though, if you don't lose your bank charter, if your bankruptcy remote securitization goes under.
No, but that's
the bad guys like to do it because they keep their charter and they both risk. Seems like it might reverse your bank. If you didn't lose your bank charter, securitization.
So it's true that here you have cross-subsidization to the bad banks, of course. But still, what gives you the incentives to the good banks is going to be any difference in the charter values. Now, the question is what they lose when losing the charter value, and that's an important question. What Lehman lost, for example, when it went bankrupt. That's kind of the question. It's not only what they lost by the bankruptcy, also the possibilities of operating in the future with the name Lehman. Now, in terms of your question, so what you're thinking is in compensation to executives?
In the future, that means related, right?
Right, exactly. So the way, right. So the way I'm thinking is. No, exactly. So I'm thinking on charter value. So is the value of the institution, the name of the bank. Now, no, exactly. So the other question is what are the incentives for the bankers themselves in order to behave in the best interest of the bank. And that enters into the question of how you want to compensate the bankers themselves in order to align their incentives to the incentive or to maintain the charter value of the bank. I don't enter into that discussion here, but I think that's an interesting discussion as well. No, exactly. Right, because if you think in a situation in which the bankers of Lehman Brothers didn't really care about the charter value or the franchise value of Lehman Brothers, they don't have any incentives to behave, and that's it. This doesn't play a role. But that has interesting consequences for thinking about the compensation of managers. So, for example, these golden parachutes may not be potentially such a bad idea. We have to think more on these type of issues. Now, Sihuo, that is true. This is a very stylized model in terms of here you want to use traditional shadow banking. And the reason is that here I'm thinking effectively on institutional investors. If you think in who put their money in traditional banks, I mean the guys like me at least, who are insured by the government, there is not much to do in terms of going through shadow banking and paying lower interest rate, etc. So I think that there is still room for coexistence of these two things by the traditional banking. This is a very stylized model, so I'm not able to capture that at all. So now going to your question, I think is the last one. I think is very important, and I really think that shadow banking, in fact, shadow banking existed all the time, much before the federal banks exist, and we see crises like this happening during those times. The thing is that without the government, without the Fed, there was no the buffer of going or running to hide in the traditional banking. There was just shadow bank at that time were called trust funds, for example, and there were no the buffer of hiding in the traditional banking. There was just bigger crisis in that sense. Here, regulation gives you a shield where to hide when the trust evaporates in the market.
Very good.
Thank you.